Okay, Sanjay Dutt of Quantum Security now joins us. Someone who really was, Sanjay was a minority. Let me put it this way. When we spoke to him during the demonetization period, and he said, "Look, I'm a buyer," and he was in minority that time. Sanjay, welcome back. Thank you for joining us. Sanjay, you were in minority when during the demonetization period you mentioned that you were a buyer and you were actually buying PSU banks. So not only markets have recovered, PSU banks are flying now. So are you a contra seller now because everybody is buying, everybody is adoring and revisiting PSU banks?
No, I don't think so, Nikuj. In fact, on the contrary, I would be worried about some of the, tier 2 private banks, the likes of Yes, Kotak, RBL, etc., because I think they are really stretched at this point of time. If this correction gives me an opportunity, I would once again actually like to add second tier PSU banks and similarly second tier private sector banks or semi-private sector banks, the likes of Karnataka, Federal, Crude Vyasa and those kind of banks. So I continue to believe that the banking financial services theme will make big money over the next few years. Fine trading corrections here and there, that's okay. But I've been optimistic on this theme for the last 1.5, 2 years, and it's really playing out well, and I think there is more steam left, and particularly in the PSU banking space, because all NPAs etc. are more or less now out in the open. Everyone's kind of factoring them in. Government is seriously now addressing the issue. We may agree, disagree with the way they'll address it or whatever details come out, but the fact is that they are now in charge, and I've understood that this is the single most problem that's plaguing growth and is plaguing the investment cycle that we all are grappling with.
How real is going to be the NPA recovery based on the new norms? Markets today are getting excited. Everyone is of the view that, okay, NPA problems now will get sorted out and every bank will be able to recover every pound, every penny, every nickel they've lost. But it's not going to be that easy. We know in the past that recovering any kind of a recovery is a very long haul and a slow process.
Oh yes, no doubt. On the NPA process and everything else, market is much ahead of what the reality is. So therefore, realistic, valuations, realistic expectations have to come back in the price, and that's the reason I mentioned that I would look at very select PSU banks, tier 2 banks, and similarly private banks. I wouldn't just say that it's still a broad theme where you can just buy anything and make money and hold on to it. So the NPA, as far as the NPA trade, I think markets are definitely turned ahead of what the reality is. I agree with you. It's going to be a challenge in trying to sort this, but at least the process has begun. That's one thing good. It'll be long drawn. We've seen it worldwide. It's not easy to solve these issues. It's not easy to really divest assets or restructure assets or restructure loans. It's a very challenging task, and actually finding buyers, figuring out what are the holes in the books, acknowledging the holes. Promoters have to acknowledge that they'll have to cede a lot of equity, give up a lot of, do a lot of things. So it's going to be tough, no doubt about it. Yeah, I agree with you.
Sanjay, hi, morning. Well, today the standout performer really is aviation and paints, and they're rejoicing the fact that, crude has seen a big cool off. We're at 5-month lows. Do you believe that just because of the crude cool off, one should be a buyer in aviation or paints for that matter?
I think aviation in India is going to be a big story for the next 2-3 years. Yes, crude is obviously the single most important factor for the aviation industry. And I'm not really a oil forecaster or a specialist on oil prices, but whatever I read and whatever I understand from the gurus, oil prices ain't going to go up in the near future. If actually they probably would remain on the lower side only, because both in terms of demand supply dynamics and in terms of alternative sources of energy. So therefore oil would benefit the airline companies. But airline as a theme, I think airline as an investment opportunity in India is big, no doubt. But getting your timing right and buying it when things are down in the dumps is what is the investment patience, what is the investment discipline that you need to have. I may not want to buy it today, but I may want to buy it when, there's an aggressive correction in the sector or in the market. And buy selectively, buy the market leaders, buy good stocks within the sector. On paints, I think it's too small a place to really, bet on. There's just hardly a company or two you can buy. You get narrowed down to just Asian Paints or something else. You really don't know what else to buy. So that's something I wouldn't want to take a call on.
Steel, Sanjay Dutt, does that ring a bell? Because you bought into steel, you bought into steel stocks, and they've turned out to be better investments than gold for you. Now that global commodity prices have corrected, are you thinking twice about buying metals? Do you think that one-time reflation trade which made a comeback because of global stability and China's spending, is that behind us now?
No. I think, we got to figure out, we got to understand and go back and see, all these cycles don't just peter out in a year or two once these commodity cycles, once this whole reflation trade in a particular industry or sector takes off. They last for a relatively long period of time. And the beauty of steel, at least for India, is that I can confidently say for the next 10 years, no capacity is going to come whatsoever, because the way the sector has been in a bad shape, the way environmental clearances and issues that are there now, it's near impossible to set up a steel plant of global capacities and global size today. Anyone who tries to do it is going to take a lifetime in trying to do it. So existing steel players who are efficient, who are of world-class capacities and also quality, will actually churn out a huge amount of money. And if you're talking about India infra spend and India domestic story, inward consumption story and whatever, and if you're talking about affordable housing or whatever, roads or whatever else, you are obviously going to consume steel and you're not going to get additional capacities. Whatever capacities you have right now, those companies are in fact getting their debts restructured and actually getting favorable terms to the government, including to the extent that government has gone and talked about a steel policy. Yeah, we can debate about it, whether that makes sense or whether something like that should be done or not. But you can clearly make out that trade in India on steel stocks is probably just the beginning. So every dip is has to be used to buy good quality stocks, because you will still get 2x, 4x opportunities in the sector. This is just a temporary break that you are seeing here. Yes, global commodity prices do have an impact on this, but I think even global pricing wise, there is going to be pricing power in steel, no doubt.
Sanjay, okay, the other point which I want to discuss with you is the fact that if there is a decline in commodity prices, it's great for a macro. It's fantastic news because we are net importers of oil, we are net importers of commodities. But along with the crack in commodities, pricing power also gets out. I mean, the experience of 2015 and 16 has been that a decline in commodity prices is great on paper, but it is not good news for earnings, and that may just delay that earnings cycle slightly. So the reason why I'm asking you this question is why, because the way copper, crude, iron ore prices have come up from the recent highs, it is a clear indication of dull global demand.
You're right, Nikunj, but we need to go and look at this sector specific, commodity specific, and of course local factor specific. I'm just digressing a little and talking about what we've been hearing even in a highly developed market like US, where there is a clear shift towards using only local US steel, what we've seen, President Trump announcing. Forget that, you may say it's rhetoric and you may say it's jingoism, whatever it is. But coming back to local, we need to look at all these things sector specific, whether will I find this pricing power and whether will I find the margins in zinc, whether will I find them in copper, whether will I find them in aluminum, or whether will I find them in steel. So you can't really paint all metals or all commodities with the same brush. Yes, iron ore and those kind of issues are there, but at the same time we've got to see what's happened to coal prices. So input price impact is also there for these companies, number one. Second, as I correctly mentioned, no capacities are going to come up in any of these industries over the next few years. So, and right now, all the companies in the last 2 to 5 years because the domestic economy has been in problems, have been running at 50 or 60% capacities, or nothing more than that, or maybe lower than that in some industries. So thus the capacity absorption or the offtake improving, and even at a little lower price point or a substantially lower price point, these companies will still make money with debt being restructured, input prices coming down for them, but huge volume, the offtake that these companies are going to get from domestic demand is going to be substantially. And right now, let's understand, every country in the world is now more or less understanding they have to protect their jobs, they have to protect their local industry, so they will keep playing with these fiscal and physical barriers. So therefore, import restrictions as well as duty restrictions. They will keep playing with this MIPs and countervailing duties and all this kind of stuff. We got to take that in the mix and then look at individual commodity. We can't paint everything with the same brush when looking at investing ideas within India itself.
Sanjay, so what about the rest of the market? Is it poised for a correction? Are we likely to see that? Because, everyone in the market is just hoping for that dip to come in and buy some more of the stocks, but that doesn't happen. This index is clinging on to 9,300. The only underperformers continue to be pharmaceuticals and IT, and that's been the story for the last entire 1 year.
I'm glad you raised this point and you mentioned pharmaceutical and IT. I'll just come back to that. But as far as the correction is there, we are missing out one big correction already happening. It's a typical bull market correction, which is a rotational correction that happens. Today we were talking about metal, steel, etc., and all these companies going down. Something else is going and keeping it up. We've seen banking and financial services staying up, whereas IT and pharma was down, but the index didn't change. Even though IT and pharma have actually been touching new 52-week lows. But at the same time, banks have been touching new highs. So index has continued to remain in that 50-100 point zone of 9200, 9300, or probably 9100, 9300, So this is typically bull market where you keep changing leadership for the short term. We suddenly saw about a few weeks back Reliance taking leadership, pulling up the index, while other stocks corrected. So therefore this rotational process will continue, even though we may not see substantial movement in the index. Now coming to your IT pharma, very interesting, I'm glad you raised that issue. That's another contrarian call I would like to make, because I normally do not look at pharma as a sector because, I'm actually a duh on that area, so therefore I admit it. But whatever little I understand, I think it's a good time for people to scale up some exposure to select pharmaceutical companies. I don't have any positions in companies, so like I said, but I think it's a time to look at something like a DV's Lab, something like a Lupin, because I think there is a huge upside in them over the next few years, because healthcare is still an issue in India, still under penetration is there. Yeah, we are living with this typical US FDA, we are living with this, government really waving the stick at them in terms of drug pricing, etc., etc. But at the end of the day, I think the sector has got tremendous potential. And same thing I feel about IT. It's a time to start looking at a stock like Infosys, if it corrects a little more, because the managements there have really started addressing the problem. So contrarian plays would be start dabbling into these stocks. Wherever you've got substantial gains, maybe shave off some gains there and start allocating a little bit to select companies. I'm again repeating, you don't need to go and buy Sun Pharma, you don't need to go and buy everything, or you don't need to, or probably go and take an index, go and take a mutual fund exposure, look at a pharma specific fund, look at some funds and go and buy one pharma fund at this point of time. But this is the time to start taking some contrarian calls in both pharma and IT.
Sure, we'll laugh if I phrase my next question centered around Maruti, but I will still take the liberty of doing that. The question which we've been asking everyone is that Maruti has given a CAGR return of 34% ever since it went public. I mean, that's a dream return coming from a very consistent and a stable business. So this is 2017. Which are 2 or 3 stocks which could be the next Maruti in making? Where do you think stock prices may go up and down? That's volatility and that's function of liquidity. But where do you think there could be a business growth or a compounding growth in earnings for about 15 to 20% for next 3, 4, 5, even 10 years?
I think mortgage finance companies, that's one place which has already seen a big run up, but you need to find some undervalued plays out there, because that business is huge. And if you go and look in the US, if you go and look at, the philosophy what Berkshire Hathaway has followed and what Warren Buffett follows, etc. We are going to replicate the models here in India also. We have no option. We are a country which is short of housing, short of affordable housing more than anything else. The government's push towards that. So I would say some cheap mortgage finance companies with excellent management. Let's take an example on RBL Bank. We had an excellent manager with a track record, Vishwa Rahuja, who's had phenomenal banking experience in India, picked up a bank which no one had heard of called Ratnakar Bank. And look what he's done to it in just a span of 3 to 5 years. If you look at it from when he took over that bank, what the price was when it was unlisted and what the price today is. Similarly, look at stories like Yes Bank. Look at what Uday Kotak has done to Kotak Bank. In financial services, that's the beauty. The kind of leverage you get when you get the model right. And it's the same thing you'll be replicating in the mortgage businesses over the next 5 to 10 years. So pick up a good mortgage finance company, check out the management, check out what it can do, and you see how the business will unravel. Because once you build a brand, and around that brand you can do so much in financial services. You can get into auto loans, you can get into everything else, and it just kind of incrementally keeps adding to your bottom line compared to negligible or very little investment and efforts.
Sanjay, what could go wrong? Do you think for markets to sell off, it could be, the selling would largely be a function of something going wrong globally, which could be the outcome of French election, what Trump does, or what will be the face of Brexit? Do you think markets run the risk of turning around sharply because of the global environment we are in?
On the contrary, I would believe, I'm of the opinion that global events are not going to have that much of an impact on us as compared to what domestic events can have. We've seen with Brexit, we've seen with Trump being elected, we've seen with a lot of things, because we are still a very inward economy, consumption-oriented growth. However, we may try to destroy ourselves, we still manage to achieve 5%, 6% growth, however slow, however whatever is collapsing before us, when we had the banking mess, the NPA mess, everything else, we still managed to grow at 5.5%, 6% because of the sheer numbers and sheer, consumption patterns and consumption theme that plays out in India, because the numbers we have and so many places where we are underbanked, underhoused, under healthcare, everything is under where there's a potential there, and why do you think foreigners are attracted? So domestically is what I'm more worried about than overseas, because overseas events just give a temporary blip and then we come back in normal life. If structurally something goes wrong within our system, within India, that's what I would be worried about. So what would worry me? If we get into a serious conflict with our neighbors, particularly with Pakistan, that can cause a phenomenal amount of prolonged uncertainty, both within domestic investors' mind, fear, as well as international investors. Some billion-dollar fund manager sitting in New York, first thing he's going to do is press the sell button, when he panics. So those are the factors, domestic factors, that worry me a lot than global. Global, I think, we've seen so many things correcting, and then once again we have this short-term 2, 3, 4 months of pain, and then we are back to, we start looking at domestic ideas, because consumption will carry on, steel will sell, cement will sell, medicines will sell, blah, 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 But what worries me, if structurally something goes wrong within India, is where the story can go wrong and we may land up with 1,000 or more than 1,000 points correction. Otherwise, I don't think there's really anything to worry about as far as our bull market is concerned for the next few years.